we're showing some numbers now actually illustrating what I just said, which is really up on the exports and the imports not as bad as we thought. Is this something indicating something broader and longer term for China and China growth, or is this about the Lunar New Year?
I think it's probably a little bit related to the Lunar New Year, but I think it also shows what we kind of all knew was happening, and that is that companies were essentially front-loading imports out of China ahead of the tariffs. And so the lopsided difference between imports and exports on the Chinese side kind of illustrates that that indeed was happening. And we've seen that on the U.S. side. And it's also reflected in the fact that, earnings were booming last year, and estimates for 2019 are, falling pretty hard at the beginning of this year. A thing to remember for China is that the Chinese slowdown started long before any kind of trade tensions began, and certainly before the tariffs were actually imposed. And so the China slowdown story is a much bigger story than just trade. The economy is slowing. They are either unable or unwilling over there to stimulate the old-fashioned way by creating more debt-financed expansion. And as a result, the economy has really been sort of in a bind, further hurt by the fact that the Fed has been, or at least was until recently, tightening, and that also sort of hampers the Chinese policymakers from reflating the economy. So I think China remains a big story, and it's one where we don't really see the roots of a recovery quite yet.
Doug, do you agree, or do the data we saw make you feel more confident about taking on risk?
I tend to agree with Jurrien. I mean, some of the global trade indicators we follow that are driven in large part by China have failed to rebound. I know the Baltic Dry Index is a pretty volatile thing, but the fact that that's crashing, at the same time you're seeing a lot of indicators of global trade softening. Another one, just related to the risk-on rally is where there's not been risk on, and sensitive industrial materials prices have not bounced at all during this rally.
So what does that tell you for the broader index? Like, do you need to sell the rally then, or is it just sort of a quick rotation allocation here?
We're pretty cautious. We're not in emerging markets in our tactical funds. We sold them out a little over a year ago. But we're cautious on this rally. I do think there's going to be a retest. Think of the fourth quarter decline as sort of anticipating weak economic and corporate earnings numbers to come over the next couple of months. And to some extent, the stock market not only discounts that deterioration, but it also is a driver to some extent in that it weakens confidence. And then very often you get the retest. So many times you see double W bottoms in the stock market. I think that's why. The first one comes out of the blue when the news is still good. The second leg down is when you actually start to get the weak news. So whether that's postponed until we start to see first quarter earnings, I don't know. But I think it's a pretty high risk rally to chase.
So Jurrien, we tend to focus on China, and it's understandable, it's such a huge economy. At the same time, it's not all of global growth. What are the indications outside of China? Because there's some indications, at least on the soft numbers, that it's not just a China problem either.
No, it is a global slowdown. The U.S. sort of got an exemption from that last year because of the fiscal stimulus, not just the tax cuts, but generally deficit spending as well. And now the U.S. has followed the rest of the world. But it's been a Europe story, of course. It's been a China EM story. And to what Doug said, he's exactly right. You tend to see these big V bottoms. We were down 20.2% for all of a New York minute on December 26th. We've seen a 17% rebound, and that kind of momentum washout low, you tend to see a very strong rebound, which is what we're seeing. And then at some point, probably over the next 4 to 8 weeks, you do see some sort of retest. It may not be a full double bottom. It may only be a 50% retracement. Maybe it's on lower volume, et cetera. But the issues that have been plaguing the markets don't go away that quickly. We know that the Fed has pivoted, but we know that earnings growth estimates are falling off a cliff. And at this point, we're lucky to get positive EPS growth in 2019. The estimates are down to 5 and falling by about 0.5% a week, actually.